I follow a lot of bank stocks really closely, and we're getting to the time of the year where it's really important to start paying close attention. This coming Friday, April 12th, is a big day for JP Morgan Chase, Citi, and Wells Fargo. These companies are about to kick off earnings season for the first quarter. They're going to give us some really important information about the state of their own business, but also a good look at what's going on broadly with the economy. I'm Jason Hall. This is Investing Unscripted. We're going to take a close look at these three banks, why I'm paying attention, and why it matters to you, the individual investor. This video is sponsored by the Motley Fool. If you're looking for even more great stock ideas, you should go to our special link. You see it right on the screen. It's fool.com/unscripted. Again, fool.com/unscripted. Go to that link. The Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check that out. This coming Friday, April 12th, these three mega banks are going to release their first quarter financial results. I'm going to talk about four main things that I'm going to be looking for from these big banks, why I'm paying attention, and why it matters to you, the individual investor. We've got JP Morgan Chase. This is the largest bank in the US by assets, and then two more of the big four, the four largest US banks, with Citigroup and with Wells Fargo. Now, before we get into the details of what I'm going to be looking for and why it matters, let me tell you a little bit about these banks and what makes them different from one another. So we'll start with JP Morgan Chase. We've seen JP Morgan Chase over the past 20 years grow at an absolute enormous rate, starting, of course, with the merger of the investment bank JP Morgan with Chase Bank, which was mostly a commercial bank. Now, these are very complicated businesses, but the difference between what they are is really simple. A commercial bank, that's what you use. That's what businesses use for the most part for stuff like deposits. It's where you keep your money, it's where you put your savings, it's where you go to get a loan for a car, a mortgage. It's where business goes to borrow money, that kind of thing. Traditional down the street banking, commercial banking. Now, an investment bank does things that are very different. Things like mergers and acquisitions, deal making, running markets. A company maybe is going to go public, IPOs. Investment banks are the ones that help those sorts of things happen. They do a lot of more things too, like trading activity. And again, not just things like trading stocks, but trading bonds, trading debt, all sorts of other things that they're involved in, the trading of, helping manage assets, lots of different things that investment banks do. Now, JP Morgan Chase, again, the largest bank in the US by total assets, and it's what they call a universal bank. It has a very large investment bank, also has a very large commercial bank. Wells Fargo, more of a commercial bank. It does have a small investment banking business, but by and large, the vast majority of its business is tied to its traditional commercial banking. Mortgages is something that Wells Fargo has been really good at, other types of lending like that for a really long time. And then we have Citigroup, which is honestly, it's kind of similar to JP Morgan Chase in a lot of ways. The difference is that it's not anywhere near as large as JP Morgan Chase, but it does have a pretty large investment banking group and a pretty large commercial banking business as well. One thing that's interesting about Citi is that after a lot of expansion in international markets for a number of years, it started to kind of pull back and really refocus back on its core US business operations. Now, let's take a look at how these stocks and these mega banks have done over the past year or so. So the chart on your screen, you can see all three of these have done really well. I've taken this back to the beginning of 2023. And the reason why I did that is, if you'll note, in around March of 2023, we saw the stocks of all of these banks come down a substantial amount after a huge run up to begin the year. This is when we saw the banking crisis of 2023 start to emerge, where we had a couple of large US banks be seized by the FDIC. And then early May, we had another one be seized by the FDIC. And we see even with that lowest points, these stocks have done incredibly well. JP Morgan Chase up 54%, basically 45% for Citigroup and Wells Fargo. And this is total return, so it includes dividends. It's really important because that is a growing part of the return profile for these larger banks. Compare that to the S&P 500, again, our proxy for the market. Market's done great over that period, up 38% total returns. All of these have outperformed the S&P by a pretty good margin, all things considered. Now, I want to put one more thing on here. This is the S&P Bank Select Industry Index. Wanted to do this because this index is made up of around 90 or so banks, roughly. And these are large banks, regional banks, these large universal banks. But what's interesting about this particular index is what's called an equal weight index. In other words, it's not a cap weighted index where we have these large businesses that really kind of move the index the most, like we do with the S&P 500 with the Magnificent Seven being something like 30% of the index. So what this shows you is that, as you can see, really, by and large, banking stocks, they've kind of gone nowhere, I guess is the best way to think about them. Now, why does that matter? So, first of all, it kind of looks like most bank stocks have been left behind by the broader market. We've seen these giant banks have done very well, right? And most banks, really, they kind of haven't done really well. Now, why is that? So, number one, interest rates rocketed up very quickly. That was a big thing behind the collapse and the FDIC taking over. For example, Silicon Valley Bank was very much affected by interest rates because they had a massive amount of exposure to loans that were yielding very low yields. Interest rates skyrocketed. It kind of flipped their loan book upside down. So why is it that the stock market has kind of left most bank stocks behind? A couple of reasons. Number one, again, we saw on that chart when the stocks for bank stocks largely collapsed when we had the banking crisis in 2023. There's still some lingering concern about the state of the banking industry. It's not a major concern. I think the FDIC has pretty well answered concerns about its ability to make sure that depositors are going to be protected, but investors continue to be a little bit leery. I think the biggest reason they're leery is not concerns about failures, but there's some of that, but it's probably more than anything, it's interest rates having skyrocketed so much. On the surface, you think, well, higher interest rates should be good for banks, right? Because they can charge higher interest rate on loans. That's true. But a lot of these banks have a lot of legacy loans on their portfolio already that they can't adjust up. They're fixed rate loans. They're getting squeezed, right? Because their costs for deposits are going up as depositors are demanding higher yields. Their loan books are not really able to increase that yield as quickly. It's just kind of harder to do, right? So that's one of the challenges that's affecting banks. Of course, the other thing too is this lingering concern about the state of the economy. Banks are very leveraged businesses. If depositors want their money back and borrowers stop paying, banks can get in a lot of trouble really quickly. So put those things together, and investors continue to be a little bit leery of banks. Now, that brings us to the things I'm really going to be paying close attention to with these big banks when they report. Number one, the first thing I'm going to be looking at is the state of their deposits. So if you think about these biggest banks, one of their big competitive advantages is low cost of capital. So far, for the most part, depositors have largely been willing to begrudgingly keep their deposits with these large banks and earn minuscule, in some cases, no yield on their deposits. At the same time, you've seen online banks offer 4% plus yields. I'm really going to want to see, are we continuing to see the trend of these big banks be able to maintain very large, low yield deposit bases? That's going to tell me a couple things. Number one, it's important to understand if they're maintaining that competitive edge with those cheap cost of capital, because it's really important to their business models at their scale that they do that. It's also going to give us some indication of the state of the American consumer. If deposits are coming down quickly, it could indicate that there's some concern that people's ability to continue to spend through the high rates of inflation that we've seen still remains as strong as we want to, or if there's signs that maybe the consumer out there is starting to get squeezed. So it's going to tell us those two things that are important, help give us a little bit of information to answer that question about the consumer, but also definitely help answer the question about the competitive edge that these banks have that's so important. What's the second thing I'm going to be looking at for the big banks? It's really important individually is looking at their net interest margins. So net interest margin is their margin on their cost of capital, how much they have to pay on deposits and any borrowings they have versus what they can earn in yield on loans that they issue. Basically, their lending margins is the best way to think about it. And we've seen those net interest margins hold up a little bit. They started to get squeezed early in the interest rate spike, but more recently, we've started to see their ability to issue loans at higher interest rates, improve those margins just a little bit. I want to see if they're able to continue to improve those net interest margins over time because of higher interest rates and as they're able to issue new loans, and if that's starting to pay off. So that's going to give some idea about the profitability for these very large banks. So those are two things I'm going to be paying really close attention to help me get a better idea of what's going on for these banks individually and some idea about the broader economy. Okay, what's the third thing I'm going to be looking at? I want to hear the outlook from the managements that are running these banks. What are they saying about the state of their business today? What is their guidance going forward? Are they adjusting previous guidance? Again, we just came out of the end of the fourth quarter. A lot of these banks have already given us their guidance for the full year, some idea of what to expect. Are they going to start guiding down? Are they going to hold firm? Are they saying the outlook's improving? And that outlook is really useful to help how you think about the economy going forward. What's the fourth thing I'm going to be looking for? I'm going to be curious to see how the market responds. Again, these big banks, their stocks don't usually move a whole lot, even around earnings. But if we do get big moves one way or the other, it's going to be some idea of what is the sentiment broadly for investors. I don't necessarily know that it's going to be investable information, but it can certainly help bolster your psychology as an investor as we move into this very volatile earnings season. Be sure to tune back in over the weekend once these companies report their results. My goal is to make a video on Friday, release it over the weekend, taking a closer look at their results, my thoughts after they report, whether I think any of these are investable ideas going forward.